Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. A confession to begin with. The inspiration behind today's title is an article that was published on the Economic Times website last week. Now, coming back to the topic of gold and the Sensex, the yellow metal has followed in the footsteps of its stock index counterpart and touched the coveted rupees 60,000 per 10 grams mark recently. Not a bad achievement for an asset class that had been written off by a lot of experts. Gold once again proved that a long history that goes back thousands of years does count for something after all. Therefore, with gold back in the limelight and handily outperforming the Sensex over the last 1 year, the age-old debate has been reignited. Will the yellow metal steal a march over its more fancied rival and reach rupees 1 lakh per 10 grams well before the Sensex hits 1 lakh? Or with India's growth story expected to gain more momentum in the coming years, will it be the Sensex that will easily beat gold to the finishing point? Well, we can have a more reliable prediction on when Sensex is likely to hit the 1 lakh mark as compared to gold. You see, given where the P multiple of the Sensex is placed, we can say that the index is more or less fairly priced right now. Therefore, assuming the same multiple going forward as well, it will take around 4 to 5 years for the Sensex to touch 1 lakh if corporate earnings grow at 15% CAGR. Bring the earnings down to say 12% CAGR and the time period goes up a tad higher to 5 years. Therefore, it won't be a stretch to assume that Sensex can reach 1 lakh over the next 4 to 5 years. But if investors turn too optimistic and assign a high P multiple to Sensex, then the target can be attained even sooner. For the sake of conservativeness though, a time frame of 4 to 5 years looks like a realistic target. Now, unfortunately, no such calculations can be done for gold. The yellow metal has neither earnings nor does it pay out dividends. In fact, if you look at it from a strict value investing standpoint, gold is not even an investment. It is a speculative asset at best, as it does not have an intrinsic value of its own, and the seller has to rely upon what the buyer is willing to pay for it in order to make his profits. However, there is no denying gold's rock-solid image as a preserver of purchasing power, and arguably its standing as the best insurance out there against the rapid devaluation and debasement of currencies. In India, however, it has done much more than merely keep up with inflation. In fact, it has given a solid competition to the benchmark index in terms of providing superior long-term returns. A basic Google search tells me that the Sensex is up 0%, 12%, and 12% over the last 1 year, 5 year, and 10-year periods respectively. On the other hand, a gold ETF, which can be considered a good proxy for the gold price, is up 14%, 13%, and 6% respectively for the same 3 time periods. Therefore, gold has outperformed the Sensex over a 1 year and a 5 year time period, whereas the Sensex has done much better than the yellow metal over a 10-year period. Now, is this enough evidence to conclude that one should prefer gold over a short-term holding period of say 1 to 5 years and opt for Sensex if the holding period is more than 10 years? Well, not so fast. You see, one of the big reasons Sensex has outperformed gold over a 10-year period is because of the former's starting valuations. Sensex was trading at a PE of around 17 times back in March 2013, which is lower than its long-term average of 19 to 20x. This means that Sensex was attractively valued therefore contributing in a big way to its outperformance vis-a-vis gold. 5 years ago, Sensex was at a PE of around 23x, meaning it was slightly overvalued. And this perhaps explains why gold outperformed Sensex marginally over a 5 year period. Let's take another data point. In March 2019, Sensex was quite expensive and was trading at a PE of more than 28 times its trailing 12-month earnings. It has returned an 11% CAGR since then. And how has gold done? Well, it has outperformed the Sensex comfortably by earning a CAGR of 16%. Therefore, it looks like when you buy Sensex at expensive valuations, that is at a PE of more than 24x to 25x, gold can give Sensex a run for its money. However, if you invest in Sensex at attractive valuations, that is PE of less than 20x, it is the Sensex that has an edge over the long term. To be honest though, it doesn't have to be an either or situation with Sensex and gold. In fact, one can take advantage of this tendency of gold to give better returns than Sensex if the latter is bought at expensive valuations and vice versa. Now here's a table that I have pulled from one of my previous presentations to prove my point further. Since 1990, there have been only 6 calendar years where the Sensex has lost more than 15%. As you can see, the average loss has been almost 26% per year. And how has gold done during these down years? Well, it has earned an average return of 14% vis-a-vis 9.6% that a bank FD would have earned. Now, gold has of course been more volatile with the lowest gain at 1.4% and the highest at 29.4%. But the good thing is that it has gone up in all the years where the Sensex has lost more than 15%. Therefore, whenever you think that the markets are expensive and you want to reduce exposure to stocks, getting into gold as opposed to bonds or bank FDs may not be a bad idea at all. Besides, if one considers the next few years, outlook for gold seems better than those of bank FDs. Therefore, in addition to its history of being an excellent hedge against market crashes, you also have the advantage of riding on a bunch of macro tailwinds for gold. All in all, it's a heads you win, tails you don't lose much scenario for gold. So if I were you, here's what I would do. I would take maybe 10% exposure to gold when the markets seem attractively valued or are not prohibitively expensive. But once they turn expensive, I increase the allocation to gold to say 30% to 40%. This way, you're playing the odds and putting yourself in a better position to outperform both gold as well as Sensex over the long term. Now, of course, there are people out there who don't believe in toggling this way between Sensex and gold and are perfectly happy having only a small allocation to gold as a hedge against an economic disaster of any kind. And this is perfectly fine in my view. But if you must take a calculated risk and intend to earn market beating long term returns, the strategy I just highlighted can be the way to go. Therefore, in conclusion, it doesn't matter whether gold or the Sensex reaches the 1 lakh mark first. To be honest, making a prediction of this kind is beyond anyone. What is within one's reach, however, is capitalizing on the upward journey of both these asset classes towards the coveted mark. And this should be grabbed with both hands in my view. Switching a significant chunk of your allocation towards gold when Sensex is expensive and moving it back into stocks when it is cheap is certainly an idea worth considering. Let me know what you think of it. That brings me to the end of this video. I hope you liked it. Goodbye and happy investing.
Hello from Team Equitymaster. We're glad you tuned into this video. If you liked what you saw and want more details on the investment ideas we covered, click the link in the description below.